Welcome back to the Aria Finance Specialist Scoop, and a little bit different episode today because I'm joined by our Managing Director, Lucy Waters. I've had the pleasure of working with and for Lucy for almost a decade now. And beyond getting sort of stuck in the nitty-gritty of the day job, sometimes it's nice to take a step back and talk about the market and how we think things are changing. But I wondered whether we should start with a bit of the background from that period of time where we rebranded, brought the businesses together, created Aria Finance. We're approaching, at the time of filming, our third anniversary, our third birthday. But I mean, how was that for you? Because you walked away from a brand that you'd started on your own, right, to do this?
Yeah. Do you know what? It was definitely an emotional roller coaster because, you know, you and I had spoke about it a lot over the years, the direction the business was going to go in. Did we at some point retire the Vantage brand? And I think when you've started something and you feel close to it, and actually it's not even just if you started it, because I know that actually you were very connected to the brand as well. And I think that you put blood, sweat and tears into something and it becomes quite emotional rather than transactional. So it had been something that had been kind of floated around for a long time, hadn't it? And to make that leap. And then actually when you make the decision, because indecision is the worst thing of all things, isn't it? So if you actually say, right, that's what I'm doing, all of a sudden the conviction changes and you get quite excited by it. And that was very much what happened. It was actually look at the opportunity, look at the things that we can do with this new brand. And we've got some different expertise and some different cultures. And, you know, there's great opportunity here. So we were genuinely excited by it, and then we laid all the plans and we had our launch date. It was September the something, I can't remember the exact date.
It was supposedly very early September. In theory it was 18 months of planning to get there.
And it was for a Monday, naturally, because it'd be weird to launch any day but a Monday. And then the Queen very sadly passed on, was it the Friday?
Thursday.
Was it the Thursday?
The Thursday before we launched. We had the champagne on ice for our launch, and then the country was in mourning. It was kicked us out a little bit, didn't it?
Yeah, so we decided to reschedule, and we thought, what could possibly go wrong now? That's about as bad as it gets, isn't it? And then good old Liz Truss decided to do probably the most worst mini budget known to man. Really destructive, particularly for our space as well, right? Yeah, absolutely. And do you know what? On reflection, and I'm not going to get into politics because I think that's a dangerous topic, but actually probably what they were saying wasn't wrong, but it just created this massive bang, didn't it? And the market changed overnight, and it was the speed at which it changed which caused the disruption. So we were there ready to go, and there was no choice at that point. You know, we were doing it, and off we went. But it was a real shame because the excitement of launch and the opportunity that we had seen became a lot more about firefighting and trying to damage limit. And there were a lot of people out there who really suffered in that time and lost money because they had deals pulled on them, and then things didn't fit anymore. You've got transactions going through and offers were pulled. It was actually, looking back on it, it was, aside from the financial crisis, it's one of the worst points in the industry for me.
I think it was a baptism of fire as a firm, right? But I do think one of the challenges then was the lack of education for borrowers about why it was happening in the background. And very quickly, our whole industry seemed to educate themselves a bit more on the mechanics of lending and pricing and how products are created. And it's probably one of the long-term silver linings that we have a far more involved and educated broking space to support borrowers and give better advice as to when a rate is good, or how quickly should you move, or are you really in fear of or at risk of losing a product. But it was really, really tough, wasn't it? It was a very, very hard time to launch. But getting through that, I know sort of my thoughts on this anyway, watching lenders react and the lending space, there was a lot of bad press. I talk quite a lot on some of the direct borrower roadshows we go to where we meet landlords and developers. People always talk about, well, the banks were greedy. The banks did this, the banks pulled my rate, the banks screwed me over. And it's probably the wrong rhetoric, right? Because actually banks were just trying to not go under themselves because their cost of funds had gone up.
Yeah, and I think that being balanced and knowledgeable actually really sets you apart in the sector, and you know, we will have seen, and I know that I certainly did, lots of brokers who would support that narrative because it brought them favour with customers. And I think in life there's a lot of people out there that think that if you tell people what they want to hear, that they will like you better and that you will do better from it. But actually, I believe completely the opposite, and I think you have to stand up to what's right and what's true. So perhaps there were some people that didn't enjoy the conversations that we were having over that period, where we were sort of saying, hold on a second, this isn't fun for anybody. They haven't pulled this rate because they want to see you in financial detriment, and they want to see you pay more to their gain. This is a case of they can't write that loan at that pricing because they will be underwater. And I think that there was probably a huge education, well, not probably, there definitely was a huge education on hedging in most lending businesses, and some did it really well and some did it really badly.
Yeah.
And then there was, of course, everything in between. And I think having the last 15 years or something being in a really benign interest rate environment, lenders didn't really have to worry about that, and they all had their hedging policies. So by hedging, for those that aren't aware, it's about how they fix their money and their cost of capital, and how they make sure that what they're lending their money at, they can say, yeah, that's what we're broadly borrowing at. Otherwise, they price something at a certain rate and then their cost of borrowing comes in much higher, and all of a sudden it eradicates not only their profit margin, but in some cases their ability to meet overheads, and it puts them completely underwater. So it's just impossible.
I mean, sensibly timed hedging enables a lender to not have to move the goalposts as much.
Yes.
Which actually, when we take a step back to what do landlords, developers, property investors trying to make good decisions in the market, what do they want? They want clarity on what they're getting to make sure a deal works for them and to see that through.
Yeah.
And it was that Q4, that back end of 2022, where things moved so quickly and was so volatile that nobody had security in the words on paper and the numbers on paper.
And I think the problem is a lot of lenders, they didn't know that their hedging policies weren't going to stand that test because they had never been tested in that way. And with the benefit of hindsight, it's easy to see. But there is also a flip side of that if a lender over hedges and they fix in too much and then costs go in the other direction, then that can be expensive for them as well. So there's a balance to be had. And I think that it was just a very challenging time. And for those who could understand that, yes, okay, it's frustrating, and it in some cases caused people some huge amounts of grief. But I think we all had to just work together, and that was the message that I was always putting out to clients, that look, this isn't the lender trying to make a quick buck out of you. And I actually still to this day don't believe that was happening at all. And there were some that were sharper in terms of, if interest rates went against them, their products were gone within the hour. And you can't blame them. At the end of the day, lending is it's a market to make money, and that's what a lender shouldn't be criticised for that. So it was really difficult. But then on the flip side, we're there to support clients, and over the years we've had some clients who have been with us for a really long time, and watching what they went through was really, really, really tough. And it's kind of like it's just a product of the environment that we're in, and there's not much anyone can do about it, but it's just about understanding the challenges and doing the best to support. And I think our team did that exceptionally well.
Do you know, I was about to say the one thing I look back and I reflect on that period of I say the late nights as if that stopped, but all the hard work that went into all that work. I'm incredibly, I know you share that sentiment, proud of the team for the care in each deal.
Yes.
And it was never just a transaction, a nameless, faceless transaction. It was people's careers and livelihoods and personal homes, as well as investment properties. So I think we pushed through that as many firms did as best they could.
Yeah, I don't think the guys were actually desensitized to it in any way. Even as it persisted, you could see the real anguish within the team when they weren't able to honour a rate for somebody, and they'd given it their best and they had escalated it to me or to you, and they had said, can you really try and fight this case? But ultimately, if it put a lender underwater, and there was nowhere to go with it. But
a lot of hard conversations were had in a 3-6 month period.
It took the shine off a bit, didn't it?
For sure, yeah, it did, yeah. But we got through it, and I think there was the borrower sentiment. I think started to education spread, and word spread about, well, this is the new normal, and this is why it's happened, and people started to understand. And ultimately, you couldn't expect lenders to sell a £10 note for £8 because if we lose lenders in the market, we all suffer for it. Yeah, so actually, absolutely. Good lending options are important. But moving past the doom and gloom of that, particularly 6 months, but it was longer than that period, really, we saw a real fight back from, and it's my favourite thing about the private rental sector anyway, is landlords' agility and resilience and how they find opportunity in a higher interest rate environment. And it was really interesting. And we saw lenders react to the inception and the innovation into higher arrangement fee products with a lower interest rate to counteract some DSCR issues. And there's still some myths around that, but we've seen lenders fight back to try and support the borrowing market, right?
Yeah, absolutely. And look, the market had to evolve because with the return that a lender needed on a buy-to-let loan, the adjustment in rental income was never going to come quick enough. Rents are catching up. And I think what we're seeing is that the demand for the really, really high fee, lower rate is still there, but it's probably not quite as severe as it was in the earlier days. But that product still very much has a place in today's market.
And it's funny, even now, we're what, 2.5 years probably post those first products hitting the market, we still get borrowers saying, love the rate, don't like the arrangement fee.
Yeah.
Do you want to talk about, as an education, as a base level, strip it back to basics, why is that not the focus on these products?
Do you know what? I find this conversation absolutely infuriating because it's not the borrower's fault. It's what they're used to. And you explain it, and you kind of do the math for them. You divide the fee up by the length of term, and then you give them an alternative with a higher rate. And I think for those who have borrowed over the years, these sorts of fees are just alien, and they think that it's madness, and it's really difficult to educate, because I think people, they hear you and they nod and they go, yeah, but I still can't pay that fee. It becomes so problematic when someone's got that mindset, because ultimately you're going to pay the same, because the lender has to achieve a certain hurdle to make it make sense to lend that money. And I think a lot of borrowers think that it's just a choice that lenders are making, like, we want to just earn more and more and more. But actually, we obviously see on the other side where lenders are really cutting their margins quite thin to compete for volume in a really saturated market.
For sure. That's the myth, isn't it? The myth is that the higher arrangement fee means they're making more money. Yes. And actually, to dispel that sort of unequivocally, it's the same amount of money.
Yeah.
Just broken up into a different sort of pot.
Yeah,
right? It's sort of a fair way of describing it.
And I think that perhaps the broker community were grateful for that piece of innovation, but perhaps the borrowing community were less grateful for it, because the adjustment, their rates have still gone from, say, somewhere between 2 and 4%, depending on what end of the market they were in, what type of product they were doing, to kind of between 5.5 and 7. And they see that as such a big rise as it is, that then they can't get their heads around the fact that the fee has also doubled at least. And it's tricky. It's a difficult one, but I think over time, as that just becomes all people have ever known, in the same way that low interest rates were all people ever knew, it will start to further normalise. And I think the broker community does a very good job at explaining it overall. It's just a wholesale change to how the market's structured that I don't think we were ever going to see people's mindsets adapt to that overnight.
I do quite a lot of banging on at a lot of the talks I do about the new normal. Actually, you acclimatise to the new normal. You find a deal that works for you in today's pricing. And hope and trust that actually if the market improves, it will work for you even better in the future.
Yeah.
There's something to be said for an acclimatization. But there was a lot of myths at the time about we would see the peak like a sharp mountaintop, like a triangle, rather than the reality is more like Table Mountain.
Yeah.
You live in the peak for a while, and you get used to it, and you slowly come back down. Borrowers have also changed sort of some of their buying habits to chase yield. We've seen a lot more newer borrowers in the last 2 years, particularly enter the bridging space, do some short-term borrowing to maximize the value in an asset, buying below market value. We've seen people divert into social housing. And again, lenders are trying to keep up, right? They're really trying to help. There's money in the market to be borrowed, and debt remains a good option for borrowers to consider. We hear so much about angel investment, find an investor, but debt has a home still in this space, right?
Yeah, look, the market is full of liquidity, and I'm sort of the memory of the financial crisis where liquidity was the problem, and this is very different because there is demand, there is liquidity. There's just sticking points in terms of where people expect it to be or need it to be in their mind to transact. So that has put the brakes on to an extent. But if I look back over the last few years, and actually it's mad to think that we are sort of 3 years into this now. It's, it feels just like yesterday, doesn't it? But if you look back, that first year, 23, was really tough, wasn't it? And we had another little peak in the June where swap rates went through the roof. And then we've seen it ebb and flow from there, and we've seen a few base rate cuts, which helps a little bit as well. And I think the market is in a decent place now. I think, where interest rates are what they are. They're going to go down a bit, I'm sure, but it's not bad.
Do you know, I see loads of talk. There's still lots of talk online, particularly on social media platforms, Instagram, LinkedIn, and other places, where people will talk down standard buy-to-let's dead. And actually, we haven't seen that as a brokerage, right? We're lucky to have quite a decent market share. We transact a large volume of deals a month, a year, and we have a particularly premium presence in the buy-to-let space. But we're seeing purchases. We're seeing purchases across the board still.
I think probably what that more refers to is your middle-class couple that have a fairly decent income, some savings knocking about, and say, I'm going to put that into a single buy-to-let property. I think that part of the market is probably all but dead. I think the accidental landlord where someone's just renting out the house that they live in and buying another one, that's a bit dead as well because of the tax treatments, etc. So I don't think buy-to-let is dead at all, but I think it's what it looks like in its new capacity. And one of my big concerns is what availability of sort of family home rental stock there will be, because there's a huge raft of people that are going into HMO, doing the more creative side that chases a higher yield. But actually, we do still need buy-to-let landlords. And there are purchases happening for sure, but it's hard to make the numbers stack, isn't it, on a single family buy-to-let purchase nowadays, with all the tax treatment and the various regulation that you have to go through. It is tough, and I think that side is really suffering. But the more professional end, I think there's a huge opportunity there.
And that rise of the professional landlord, again, something we talk about a lot, but as a firm we shout about in the market. That has benefits for lending as well, right? Lenders want to work with professional landlords.
Some do and some don't. I mean, what our end of the market, yes. So what we have exposure to, that is exactly where they want to be.
Yeah.
If you go into the more like mainstream bank end of the market, a lot of them won't lend to portfolio landlords, or they don't lend where it's, most do limited company now because it's hard to avoid, and that's where the market's moved to. But it wasn't that long ago that some didn't have a limited company product, or they don't do HMOs. And the more quirky type, what they class it as quirky, that's probably still quite mainstream for us, isn't it? But there's a definite push through to the specialist space, which I think again creates opportunity for us and for other businesses in the space to help people to try and re-navigate their their journey and you know, pick a new direction, because I think just growing a single let portfolio is a big challenge, and I think we'll see landlords selling off that stock because it's just too hard to make money in it.
Yeah.
So I think it's a change, but I don't think landlords are just going to hang up their boots and say, well, I gave it a good go, now I'm going to go and do something else. You know, this is their jobs, it's their occupations, and I think credit where credit's due, they're pretty good at weathering the storm.
Yeah, in an incredibly robust market, I would say, and robust people in the space, which is a good thing. When we talk about debt, if we digress ever so slightly, you know, we as a firm, we're not necessarily sourcing people with angel investors or equity partners. We're looking at traditional debt, specialist debt, whether it's private banks, challenger banks, high street or specialist lenders, everything in between. What are some of the mistakes that we're seeing right now that you think of note for people going into debt, maybe for the first time, or maybe just their expectations are wrong? What are some of the things that people maybe...
That's a good question. I mean, if I had to sort of summarize it, I think there's a lot of noise and smoke and mirror out there where the market's flooded. There's a lot of lenders, and I've talked about this recently because there's a lot of money, there's a lot of liquidity out there, a lot of new entrants to the market, and there's a lot of headline rates and shiny products that have quite good marketing campaigns. But the devil's in the detail with these things, isn't it? And I think that it's easy for people to get a little bit blinded by what they're seeing out there before having like a proper quality of advice and talking to people that know the market and understand the market. And we, as a business, we make sure that people are aware of what is out there. So if we think there's a product which suits them, but there is a cheaper product, we have that conversation. And I think it's important to have that level of transparency. And we're completely impartial as a brokerage, and it's important that people know that what we're suggesting ticks a number of boxes. It might not be price only, or it might be, it might be the best price out there, and coincidentally that might be the best product out there. But I think it's very easy for people to get caught up in the hype because everyone talks a good game, especially in the bridging space, actually. I think buy-to-let's slightly different.
Particularly crowded. It's a particularly saturated lending market, though, isn't it, bridging?
Yeah, and if you get that wrong, especially as a first-time investor, the consequences of getting that wrong are pretty severe. Compared with a buy-to-let loan, if you take on the wrong bridging product and you've got really high cost of borrowing, but not just the cost of borrowing, but actually you don't know how that lender is going to act and behave in a scenario where you might hit a snag because, look, it's the first time that you've done it. And even if it's not, these things happen, right? We see it happen time and time again, for the most seasoned of property people, that a good plan sometimes doesn't come to fruition for one reason or another, whether it be sort of macro or something that's happened uniquely to their project. So it's so important to make sure that the people that you're working with, it's not all just talk and headline rates, because there's just so much more to it than that, isn't there?
I think that is the big mistake, is people looking for, it's a rate chase rather than is it deliverable? Is it in my time frame? Does it still work from my yield perspective? Yeah. And this project is riskier, or it's tighter on time, or it's not. Do I have someone that's going to look after me and partner with me throughout the life cycle of my, you want a 360 loan? Yeah. And bridging is a really good example of, it's so easy for bridging lenders to come to market. You meet somebody but the hotel pool, high net worth from abroad with £10 million to deploy, and you come back a bridging lender. Yeah. And start throwing it around. Most bridging lenders can get money out the door quickly. That isn't the key selling point of bridging anymore. No. It's how are they funded? How much control do they have? How are they going to look after you? And you're right. If something goes wrong where you get to the end of term and you need a little bit more time, what's their policy? Do you check up front? Is it a humongous extension fee? Is it immediate repossession? Is it default? Or will they work with you to support, to pay a bit that's due, but then help you get out into the right sort of product at the exit? So I think everybody taking a breath and taking sensible debt is more important than just the cheapest debt, right?
Yeah, look, I think trust is everything, and it's about the people that you deal with. But when you're first getting into the sector, that's obviously hard, because unless it's a recommendation, it's the first time you're dealing with anybody. So
Yeah.
I think it's really important to check credentials and to look at how long these people have been going. And I think there are other things that you can look at, feedback and stuff like that, which is mixed, isn't it? Because quite often you get, disgruntled people that will have an issue with a lender because they haven't performed. So you have to be a little bit careful of that. But I think longevity in the market is a really good one. And that's not to say that newer entrants shouldn't be seen a go, because actually you get some really good new entrants backed by really good people. But I think having like proper advice and having somebody that you can rely on is key. Otherwise, you're going into the unknown a bit, aren't you?
Very much so. We did some content not long ago about what's the focus when delivering a product. And actually, to quote you, one of the lines I like within that was, the best deal is the one that delivers.
Yeah, absolutely.
That's the main thing, is what's actually going to hit your bank, support you in achieving the project, and whatever the outcome you're looking for is, and then successfully move on to the next and the next. And it's that long-term game.
Absolutely. And sometimes when I'm talking to people and they've found something that's really cheap, I would never go to say, that won't deliver, because, sometimes it does work and that's great. But it's, if somebody could say to you, right, if you take this product, you've got like a 90% chance of delivery. If you take that one, you've got a 25% chance of delivery.
Yeah.
If you've got 3 or 4 weeks to turn it around, it's a really big risk taking the 25%. And you might be in that 25%, and then you could be quite, you have a lot of conviction, and you say, well, look, actually, I got it done and it was cheaper, and that's great. So it's not to say that it won't deliver, but it's higher risk. And I think that's always what we're trying to talk to people about, that, look, you have to make that decision informed, but if you want to go down that route, you are taking a bigger risk. And I think sometimes people don't want to hear that, because ultimately every penny they save and the cost of borrowing drops straight to the bottom line. And I get that, they're commercial people, and it's the difference between whether you make a 25% or a 30% return. It can be everything, but ultimately you have to be very careful, because sometimes it can end up being more costly in the long run, both delays, penalties, overruns, all sorts of things.
Yeah, I agree. I mean, the market's full of bravery and people taking risks. But I heard a great saying the other day that I liked, which was, fortune favours the brave, but not the stupid.
Yeah.
So taking that breath and considering your position is really, really important.
Yeah.
If we look ahead, if we move forward to what's coming, what's next, what are your thoughts on, I guess, two fronts here? What's going to happen to rates in the next sort of 12 months? Do we think the rate market is still coming down? Is it going to come down quickly, slowly? I know my thoughts, which I assume the same. What do you think?
Look, we get asked this all the time, and one thing I say is that what I say today, even by time this is released, I could give a different answer. So I caveat it to, it's really fluid, because at the moment, inflation has been stubborn, and we didn't expect it to be stubborn. And when we saw some positive moves in inflation and we had base rate cuts, it was followed quickly by a spike. So it's really hard to say, because the market is reacting to what's happening. We have a budget coming up, a late budget, which is not very welcome for the market, because I think people just want to get on with it. They want to know, and I think people are nervous about the budget, especially as there's a lot of reform. There's a lot of reform around stamp duty and ongoing property taxes, capital gains tax on principal residence. So all those things can have a massive impact, and obviously that feeds into what interest rate decisions are made, because it's based on the macro. So I think looking at it purely from today, it feels like we're in quite a steady place. So swap rates have been bouncing around, but fairly stable
for a little bit.
And there was an anticipation that we might have another base rate cut soon. Probably that's not going to be the case, but I wouldn't say it's unrealistic that we would see at least another one this year. Just depends on what other data comes out to support that change. I definitely don't think it's coming down fast. And one thing that I say to people all the time, because well, I might just wait and see because I think rates might come down a bit by then. And we're talking, say, between now and the end of the year. A lot of what is expected to happen is already baked into the cost of borrowing, as you know.
I wanted to smash that myth. The base rate's not a key indicator to what's going to happen, right?
For the benefit of the listeners, of course, because, you understand it. But there's a common misconception in the market that base rate reduces, cost of borrowing goes down straight away.
Yeah.
And obviously, if you have a variable rate and you've got that product already, then your cost of borrowing does go down because it's usually linked to Bank of England base rate. However, if you're taking out new borrowing on a fixed rate, which is what the majority of the market does at the moment, it is very much a case of, as you know, what the market has predicted for the months ahead. So your swap rates are already seeing that interest rates are going to come down a little bit. And if they think they're going to go back up, then the swap rates are going to go back up. If we see some news that is far from positive, then you see that bounce up quite substantially. A bad budget. So actually, one of the biggest pieces of advice that I can give to anybody is don't hold off your plans for short-term base cuts. I mean, if we're talking you've got a portfolio and it's, you're not really bothered to do much, you could change it, you could not. That's slightly different. But if you're looking at making acquisitions and you want to draw money out and you've got something on a high variable rate, the cost between now and the point that you think it's going to be much cheaper will probably entirely outweigh, if not nearly outweigh, the benefit of waiting. So you wait to see if interest rates come down and they come down 25 basis points, but then you've been on a higher variable rate. It makes no sense. And we've seen a lot of people over the years, the last 3 years, put their plans on hold and then end up, we've transacted pretty much in the same place that we would have done when we first started talking to them. And sometimes the positions got worse. Sometimes it's sort of there or thereabouts. Sometimes it's slightly better, but on average, it's there or thereabouts. So I think it's important to say that we have that helicopter view of the market from talking to lots of different people. And it's hard to convince people because it sounds a little bit like we just want them to go ahead for our interest. But actually, our interest is our customers getting the best possible outcome that they can, because that's what makes a customer a one-time transaction to a lifelong customer. And I think that it's important that people realise that most brokers in the market would share that view as well. Brokerages aren't successful because they deal with a customer in one transaction. They're successful because they look after customers for a long time and sometimes generations.
Yeah, completely. And also, none of us have a crystal ball. And actually, the big sort of secret is that we have a fear of the unknown as well. So dealing with what's in front of you, if it looks fair and reasonable, is sometimes the better option.
Take what you can see.
For sure, I think so too. Yeah. One thing that, people maybe do or don't know if they follow us online is that we're a little bit different from a lot of brokerages in that you and I, whilst running the business, write business as well. We deal with borrowers, we deal with transactions ourselves. We still have one foot to the flame. You particularly have done that throughout your career. And typically we're dealing with larger loans and we see a lot of high profile borrowers and people looking to consolidate larger portfolios or begin a larger transaction.
Yeah.
How is that different? How is that different for a borrower, and why should they be maybe engaging with a broker in a slightly different way up front?
I suppose it's horses for courses, isn't it? If you're remortgaging your house and it's a rarely sort of a straightforward transaction and it's price driven and it's, your income's pretty standard, there are a ton of really fantastic brokers out there. Yeah. And then when it comes to the specialist end of the market, it's all about experience, isn't it? And what people have seen and transacted over the years. And we have a really strong team of people, don't we, that know the market inside and out. And then when it comes to the more complex in nature and the higher value transactions, I think it's really important for people to be able to talk to someone that understands it really well. And I think we can offer that whole chain of different experience levels, and we've got people that have been doing it for 15, 20 years in our business who are absolutely fantastic, and you've got people that cover different parts of the market as a specialism, whereas we're not generalists. We do have those specialisms in the exact products that people are looking for, whereas I think a lot of brokerage firms, they will have some connections in the specialist space for sure, but it's like anything, isn't it? If you want something which is really specific, you're always going to get a better outcome by going to someone who covers that part of the market rather than the whole market.
I think so too. And I think one of the big bits of advice for me for borrowers with that is, once you've found a firm that you think has the competency and the experience to deliver for you, is don't share details of the transaction, share the story. Here's what I've done, here's what I'm looking to do, here's what's on the table right now, here's my background. And actually, because finding that, you'd be surprised, I think, within the borrowing space for landlords and investors and sort of up and coming property professionals, to learn how much lenders listen to that in our world. Actually, specialist lenders back the person as much as they do the asset. And sharing that up front with a good broker who has the ability to put that story in front of a decision maker and to position you in the best light can lead to bespoke pricing sometimes if the loan's large enough, an exception to criteria, a slightly different process, and ultimately strong results. And it's all about working in partnership, and that's not just borrower to broker, broker to lender, it's everybody involved in the ecosystem.
Yeah, absolutely. And I think that it's when you present something to a lender, I think that the credibility that comes with the understanding, rather than just sort of post boxing the information, a lot of borrowers will sort of think, well, why do they need my assets and liabilities? This is a limited company purchase, and it's being able to educate people to make sure that you extract the information that you need to get them the best deal. And I think we do meet a lot of resistance from people about supplying certain information up front, and it's about making sure that they understand why, and that it's not just we haven't got a checklist and we're just ticking boxes to say we've got this document, that document. You ask for what you need, and you're able to give a rationale as to why you need it. And I think that gives you a higher chance of success. And sometimes I say this over and over again, having difficult conversations with clients is not something that I personally shy away from, because actually that leads to a much more honest, well-rounded relationship than if you're just a yes person that tells them what they want to hear.
I totally agree. Leads me into sort of my final question and the final sort of sentiment I want to leave out to the listeners and anyone watching and listening in. What advice do you have? Let's just say we're at the newer end of the market. We've got people who maybe are landlords already looking to now start developing or taking debt that they've not taken before, new debt into the market. What advice do we have for borrowers entering in this market now? What should they be looking for? What should they be considering when they're looking at debt? How should they be approaching that?
Naturally, I'm quite risk adverse, and I think I take quite a conservative approach. And often when I speak to people, they've had it drummed into them to really push the leverage and push as much as they can and do as much as they can. And I personally believe that whilst there might be a top end of where you can get to in terms of borrowing capacity with the deposit that you've got available, the cash around you've got for the project, you can sort of say this is the absolute maximum. If you hit a bump in the road, then you're in trouble. So I would always say definitely have ambition, and we want to see people that are ambitious and want to grow. But for the first one or two, just make sure you leave a bit around you. We see so many things go wrong because people have put every penny they've got in and they've borrowed every penny they can borrow. And if things go against them, because it's easy to have rose-tinted spectacles, isn't it? And say, look, this is what I think I can achieve with this. But it doesn't always work out exactly to plan. Sometimes your return might be slightly less, or you might hit some delays. And if you haven't got the capital behind you in order to weather that storm, it can be quite a quick and not very successful journey into property. So
Yeah.
I think that's something that we see, and it's really important that you don't get pushed into biting off more than you can chew.
Yeah, proper due diligence, sensible decision making. And if I can add to that, I think my big piece of advice for any borrowers and anybody looking to get into the market that might be listening is talk to an expert in the field. I think it's a specialist world, the finance world, for investment for professional landlords. Speak to a specialist in it.
Yeah.
I have a natural bias for that, obviously, but there are a lot of really good firms in our space. We have some fantastic competitors. We are a market leader in ourselves, but if you're not talking to a brokerage or somebody that can advise you in who's dealing with it day in, day out, then you're not necessarily going to get the most accurate advice.
Yeah, absolutely.
Yeah. So hopefully that has been helpful. It's been really good to talk about the market. As always, back to work for us now.
Another day in the office.
But thank you to everybody who's tuned in or listened, wherever you found us. And if you have any questions or want to engage with Aria Finance and speak to Lucy or myself, you can find us on our socials, which I'll have all links below. Or you can reach out to the team via the website or by calling the office direct. Hopefully hear from you soon.